Right now, Strive Inc., trading under the NASDAQ ticker ASST, is sitting at a price of $1.37 per share. That's a gain of about 0.74% on the day. If you just glanced at the market open, you saw a very different picture. The expectation was set for another brutal day. The stock gapped down at the bell from yesterday's close of $1.45, opening at $1.38 and immediately tumbling to a low of $1.31. For anyone holding, that 9:30 a.m. drop was a moment of pure panic, confirming the bearish trend that has seen this stock fall from a 52-week high of over $13. But the reality, just minutes into the live trading session, is a sharp reversal. That $1.31 low was not a floor breaking, but a springboard. The price has aggressively climbed back, erased those early losses, and is now fighting to hold in the green. This isn't just a stock drifting, this is a battlefield. And the volume, already at 13.8 million shares traded in the first few minutes of the session, tells us the fight for this company's future is happening right now in real time. What's driving this intense minute-to-minute volatility? Most investors see a sub-$2 stock and lump it in with the rest of the high-risk, speculative microcaps. They see the 52-week range, from a high of $13.42 down to a low of 33 cents, and they assume this is just another fallen angel, a story that has ended. But they're missing the entire plot. The reality is that Strive Inc. just executed one of the most interesting, aggressive, and high-stakes financial maneuvers we've seen in the small-cap space this year. Just this week, the company announced and then priced an upsized offering, not of its common stock, but of a brand new preferred stock, which will trade under the ticker SATA. This isn't just a small capital raise. They raised $160 million, and to attract that much capital, they're offering an initial annual dividend of 12%. This is a massive cost of capital. The crucial question is why? Why would a company take on such an expensive form of financing? The answer is their entire business model. Strive has publicly stated the proceeds are for general corporate purposes, which includes, most importantly, the acquisition of more Bitcoin. Strive has fundamentally restructured itself. It recently merged with Asset Entities and Semler Scientific to become what it calls the first publicly traded asset management Bitcoin Treasury Corporation. This isn't a company that just dabbles in crypto or an asset manager that offers a Bitcoin ETF. This is a company whose stated corporate objective is to accumulate Bitcoin on its balance sheet, to increase the amount of Bitcoin per share for its common stockholders, and to outperform Bitcoin itself over the long run. This SATA offering is their way of getting the funds to buy more Bitcoin without diluting the common ASST shareholders, which they see as a breach of their core philosophy. This philosophy is the other half of the story. Strive's asset management arm, which manages over $2 billion, was founded on a very specific and to some a very political platform. It rejects what it calls stakeholder capitalism, the idea that corporations should serve a broad range of interests, including social, environmental, and political causes, often grouped under the ESG banner. Strive's entire brand is built on shareholder primacy. They've publicly stated their sole obligation is to maximize long-run value for their investors, not to push social agendas. This anti-ESG, pro-shareholder stance is a powerful marketing tool. It has drawn a clear line in the sand and attracted a dedicated base of investors who are tired of what they see as corporate political activism. It also, however, makes them a prime target. And that brings us to the short sellers. This bold, leverage-to-the-hilt Bitcoin strategy, combined with their polarizing political stance, has painted a massive target on ASST's back. When you start to investigate the short interest on this stock, you find a very confusing picture, one that perfectly illustrates the battle at play. Some mainstream data providers, like Seeking Alpha, will show a relatively mild short interest, maybe around 2.95% of the float. It seems insignificant, but if you dig deeper, other data aggregators and financial platforms like StockTitan report a much higher figure, with some estimates putting the short percent of the float at a staggering 38.58%. Why the massive discrepancy? It comes down to how and when the data is reported, how synthetic positions are counted, and the chaos caused by the recent complex mergers. Let's assume the shorts are heavily involved, as the 38.5% figure would suggest. What is their argument? The short thesis is clean, simple, and frankly very compelling. They are betting that Strive is a house of cards. They see a company that is not yet profitable, with a negative EPS of over $1. They see that company now taking on $160 million in new preferred stock obligations that demand a 12% annual dividend. That's a massive cash drain that has to be paid regardless of what the stock market or Bitcoin does. The shorts are betting that Strive is using an incredibly expensive form of debt to buy an extremely volatile, non-cash flow producing asset. If the price of Bitcoin trades sideways or worse goes down, Strive will be bleeding cash to service the SATA dividend, all while its primary treasury asset is stagnant or falling. The shorts are betting this model is unsustainable and will lead to an eventual collapse. And the bears have ammunition. If you look at the insider trading filings from early October, you'll see significant insider sales from top executives, including the CEO and CFO. While there was some buys in September, the more recent large volume transactions were sales. For a short seller, there is no stronger confirmation than seeing the captains of the ship selling their own shares. It feeds their narrative that the people who know the company best are getting out. What's your take on this? Do you think the 38% short interest figure is accurate, or is it just noise from the recent complex mergers? Let me know in the comments. So, how can you as an investor get a clearer picture of this short selling pressure? You cannot trust a single short interest number. The first thing you need to look at is the days to cover ratio. This number, which is based on the short interest and the average daily volume, tells you how many days it would take for all the shorts to buy back their shares. A high days to cover number can indicate a potential for a short squeeze. Second, you must look for the borrow fee rate. This is the interest rate short sellers have to pay to borrow shares of ASST. If this rate spikes, it means shares are becoming scarce, and it's getting very expensive to maintain a short position. When that cost gets too high, shorts are forced to buy back, which can ignite a rally. And finally, and most importantly for a stock like this, you need to understand fails to deliver, or FTDs. The Securities and Exchange Commission, the SEC, literally publishes this data. You can go to the SEC's website and download the raw text files. It's not user-friendly, but the data is there. When a short seller sells a share they didn't borrow, they failed to deliver that share to the buyer. While some FTDs are normal for clerical reasons, a persistent and growing number of FTDs in a single stock like ASST can be a sign of significant market stress. It can imply that so many shares have been shorted that there are none left to borrow. And it's a key signal that retail investors on platforms like Reddit and X look for as a sign of a potential massive short squeeze. Of course, this is where we must be extremely careful. The retail chatter around ASST is already picking up. We're seeing the classic language about algos accumulating and rocketing the squeeze. But chasing a short squeeze is one of the most dangerous games in investing. It's an attempt to time a violent, unpredictable event. A squeeze needs a powerful catalyst to ignite it. Right now, the shorts are betting the SATA offering is a fatal weakness. The bulls are betting it's the rocket fuel. I want you to comment below with your honest prediction. By this time next year, will ASST be back over $10, or will it be struggling to stay above $1? So, as we watch Strive Inc. hover at $1.37, fighting to stay green after that nasty morning drop, you have to understand what you're really looking at. This isn't just a 0.7% gain. This is the market attempting to price a highly complex, highly leveraged bet on the future of Bitcoin. It's an asset management company that has simultaneously become a Bitcoin treasury. It's a business funded by an incredibly high-yield preferred stock run by a management team that has explicitly declared war on the entire ESG investing complex. The expectation, if you just looked at the chart, was a simple, dying microcap. The reality is that this stock has become a proxy for the entire crypto debate, a lightning rod for the anti-ESG movement, and a prime target for a massive short-selling campaign. This is one of the most fascinating and dangerous stories on the market today.